Thank you everyone for coming to my tutorial. I'm Ziyuan Wang from Swinburne. That's Australia, Melbourne, far, far away. Let me give a bit introduction of the blockchain lab I work in. So it's located in an umbrella platform called Digital Research Innovation Capability Platform. So there are 6 research topics or say research centers in this platform. That's including blockchain and other areas. We are also interested in AI, IoT, visualization, cybersecurity, and data analytics. So the purpose of this digital platform is to accelerate the research we are doing, accelerate them to really into the practical world to help the industries like in healthcare or education, in finance, manufacturing, marketing, retail, and transport. So today's talk, I'm going to talk about 3 parts. The part 1 would be very basic blockchain 101. That's for audience who are new to the area or who want to refresh the basics of blockchain. And the second part would be focused on the financial services. So give a bit overview of the industry, then talk about 4 applications and also 2 platforms for these applications. And the last part would be the key lessons we learned in practice in how to bring those initial idea to proof of concept to pilot and then finally into production. So let's start. Let's see the big impact of blockchain bring. So those statistics are from multiple sources. So they predict in 5 to 10 years what impact blockchain will bring. So first, there will be 10% of global GDP that will be stored on blockchain or blockchain-related technologies. And the second part is there will be 360 billion the business value added by blockchain, and it will be exceed 3 trillion by 2030. The third statistic is about $20 billion estimated revenue of the blockchain technology market. And the last one is about the banks. About 30% of the infrastructure cost will be reduced by enabled by the blockchain technology. And that's equivalent around $12 billion. So why blockchain, why this big impact? We can make it into the very basic, very, very fundamental reasons. There are two reasons. So first, it enables exchange of value without trusting intermediaries. And the second is it's maintain a single source of truth and a shared set of rules across entities without anyone being able to alter them and control the system. So the value here, we mean it's not only the cash or the cryptocurrency, it's anything that is capable of being owned or controlled to produce value. That's called asset. And there are 2 fundamental types of assets, the tangible and intangible. Tangible asset like a house, so we can use blockchain to transfer the title of property of house, and the intangible like mortgage or the financial bond or the IP intellectual patents, also digital asset like music or movies or arts. Cash is also an asset. So blockchain has the capability to shift the cost of trust. I use shift here because I don't want to say it will reduce the cost of trust, because running blockchain, certainly it comes with cost. So I would say it's a shift of the cost for trust. Let's take a step back to see the problems nowadays, or say problems before blockchain. So each parties in a business network, they would keep their own records of the transactions, like the events happen with each other. They take their own record. And the drawbacks are it is inefficient, expensive, and vulnerable. Expensive because there's the duplication of effort and the intermediaries add margin for service. Inefficient because the contract is duplicated by every network participant, and there could incur manual errors or inconsistency of records for the same event across multiple entities. There are also the fraud risk and cybersecurity attack. So with blockchain, with the shared ledger into the business network, what benefits we can get is the consensus, provenance, and immutability add into the business network, because all the members would share a common ledger, and it also provides privacy into the business, because the blockchain the smart contract can govern who can see what. Like the banks, they can control their privacy services. Other core benefits would be save time. The transaction time could reduce from days to nearly real time. It remove cost by the overhead and the intermediaries. It reduces the risk in data tampering, fraud, and cybercrime. So in the end, it increases the trust through the shared processes and the record keeping. Now I move to the core techniques. There are three techniques. That's asymmetric cryptography, digital signature, and hash functions. And the first part, so the asymmetric cryptography is about use a pair of keys for encryption. So use the public key for encryption and private key for decryption. The messages encoded using public key can only be decoded by the private key, and the secret transmission of key for decryption is not required. And every entity can generate a key pair and can publish their public key to the people they want to interact. And the next technique, digital signature, mainly used for authentication. That's a way to prove that a message originates from a specific person and no one else. It's a guarantee of the source of the data and proof that the data hasn't been tampered with. So your public key is how others are able to identify you, and your private key gives you the power to digitally sign and authorize different actions on behalf of this digital identity when used with your public key. And the third technique is hash function. It's about taking in any input and produce an output of a fixed size. So for example, the input hello goes through this hash function SHA-256. It will produce a hash, and it's a digital fingerprint, which means it verifies and confirms that the output produced from hashing hasn't been meddled. The SHA-256 is one example only. There are many different types of hash functions, and Bitcoin uses this, so it outputs 256 bits of ones and zeros. The property of hash function, there are three main properties. That's deterministic, means the same input yields same output, and this can be used to verify that two documents are the same. For example, if you change anything in the input, like a capital hello or a small version hello, the output of the hash would be just different. and it is one way. Given the hash, it's hard to discover the input. It is also collision resistant, very hard to find two inputs that yields the same hash. So blockchain, it's a combine and apply these core techniques in a unique and very innovative way. So it established trust among unfamiliar or unknown parties by the cryptographic protocols and made up of sequentially grouped and verified blocks of transactions. The blocks are chained together and creating a shared record of all transactions. The information is verified and stored in a peer-to-peer network by consensus with no central authority or intermediary. And it is immutable. It's very difficult to change something and hide the change to the whole network. Next, let's see how does a blockchain work from a very high-level point of view. Someone start a transaction request, and the request would be broadcast to a peer-to-peer network consisting of the computers we also called nodes, and those nodes would verify the transaction using different type of algorithms like proof of work or proof of stake authority. And once the transaction verified, it will be added to the chain, and the new block is added to existing blockchain in a way that permanent and unalterable, so the transaction is completed. The key point of this slide is to clarify some common misunderstandings. Those are mainly caused by people thinking blockchain as Bitcoin, or they only see the tip of the iceberg, seeing the different types of cryptocurrency. But blockchain is like the underneath, the fundamental technique to enable the applications on top. The misconceptions including thinking there is no privacy or everything is shared and open. It is lack of regulation. It is not secured, many hacks, and also consume intensive energy of mining. Like I just mentioned, so Bitcoin is the first popular application. There are so many varieties of different blockchains. And move to what the blockchain for business. There are 4 basic requirements. The first one would be able to choose what to share. The business network decide what asset to share on the ledger and what rules to access this asset and the change of the states. And the next requirement will be identity. The parties need to know who you are dealing with, because in the financial service, it's heavily regulated, and you must know your customer. It's short for KYC, know your customer, AML, anti-money laundering, and CFT, that's combating the financing of terrorism. So this all require that business know who they are dealing with, and it's achieved by the identity built into blockchain. The next requirement would be the consensus. The transactions would be you can prove that the transactions are endorsed by the necessary parties, like the sender bank or receiver bank or the payment providers. And the last one, but not least, would be the privacy and confidentiality, because the transaction visibility is only need to know, and we need to protect the competitive advantage and through the privacy and confidentiality capability. So next part is about the financial services application. I will start by having a overview of the current status of financial service, seeing their challenges and what of these challenges could be addressed by blockchain, and then give four applications that I directly worked with when I was in IBM Research Lab. And the last part would be the platforms for enterprise solutions. So with traditional financial services, there are many rising problems. For example, that's outdated and inefficient processes. There's long settlement delays, heavy fraud, and overhead, and also the risk of concentrated risk. So nowadays, other than the foreign exchange, basically all the other processes that's not, you can't achieve real-time settlement. So give an example of the Australian stock market. The overhead is about $4 to $5 billion of end-to-end cost in the Australian stock market. That's ultimately would be paid by the issuers and the end investors. And we see that's why the financial service kind of pioneer in exploring and in explore the blockchain technology and try to put it into production to reduce or mitigate those rising problems. There are so many use cases that has been identified or has been experimented. That's including the capital markets, investment banking, commercial and retail banking, and insurance. And that's the different verticals. And in the horizontal, like in regulation, there's also this reporting and compliance like KYC and AML. As the previous tutorial talked, it's not trivial to decide when you need to use blockchain or what are the criteria to use blockchain to avoid unnecessary use case or the use case not make sense. What we find is that there are a few features that exist, like the business problem to be solved can't be more efficiently solved with other technologies. And there's identifiable business network with participants, assets, and transactions. The last, there's a need for trust with consensus, immutability, finality, and provenance. So we worked for different applications in the financial areas that I will go into describe one by one. The first one is called shared KYC. What is KYC? That's know your customer. That is a set of process that the financial institutions must implement when they onboarding a new customer for any services they provide in order to comply with existing regulations. KYC is a portion of what is more complicated called CDD, that's customer due diligence. Well, this process is simple for single individuals, but it can be quite complex when you're onboarding a corporate organization. So our goal for shared KYC would be provide a technical solution for the corporate KYC that will be faster, more accountable, and eventually cheaper. The pain points of the current corporate KYC would be a very bad poor customer experience, because when they need financing, they need to go through the same long process every time. And for the financial institutions, it's an expensive process, time consuming, and they can also happen very high penalty when they not complying with the regulation. It certainly cause a bad image when they fail to do their KYC. And for regulator and auditors, there's a lack of standardization and lack of efficiency because they don't have information access to the real time. It only happens after the reports of those violation of the regulate process. So we try to revolutionize the process by envision in the future, the corporate KYC is performed on top of an integrated platform, which not only makes it more effective, but also can develop new business opportunities on top of the platform. By having a single integrated platform based on blockchain, we expect to see the increased speed from 3 to 4 weeks of onboarding time to reduce to 1 or even less by compressing data gathering and automating the process. It also reduces the costs significantly to at least 20% by eliminating the duplication through shared services. Certainly the risk of violation will be reduced by the blockchain that act as an immutable, assured audit trail of all the corporate KYC processes. And the last but not least would be enhanced experience for the corporate customers by instant visibility across all shared information and secure through the consent-based mechanism controlled by the information access. The shared KYC scenario would include these 5 key parts. That's the customer, the first bank called fulfilling bank that establish a relationship with the customer, and the requesting bank, that's another bank onboarding the same customer and require the KYC information. And all the information through the KYC portal, that's the point of access for the customer to manage its information in the network. And the regulators can to verify the compliance and perform investigations and audits by inspecting the blockchain. So the parties form a consortium to share KYC information while respecting their business constraints. Next, I will talk about the constraints for business. The first one would be the anonymity of a relationship. Because the relationship between a customer and their bank should be confidential. That means when you sharing or requesting the KYC information, the bank's identity must be hidden. Please note the identity hidden here is the bank identity, not the customer's identity, because the whole purpose is to know your customer, know the identity. And the second constraint is the access control. That's access to a customer profile and corresponding documentation must be explicitly granted by the customer. That is regulated by the consumer data rights in Australia and also other regulation in other countries with similar protection for the consumer data. And the last would be the dynamic permission. The consent is granted and revoked in accordance with the evolution of the consumer bank relationships. So we designed this model for privacy and consent. That's 2 parts. The first is a consent model that is to define how access to profile and sensitive information managed and granted or revoked by the to preserve the confidentiality of the relationship. And the second model is a document share model that allows for anonymous but verifiable share of documents based on consent. And to get more details of the two models, I recommend you to see the paper called Double-Blind Consent. I give the reference here. So that's double-blind anonymous because the providers, like the two banks, they can share the KYC information without releasing the real identity of the bank's identity. And here is a high-level architecture. Basically, we follow 3 layers. The front end is to provide the portal to the customer, to Bank A, Bank B, and regulator. This supported by the backend services, and then this backend will be interact with the blockchain infrastructure. Now I move to the next application called bank guarantees for commercial property leasing. A bit introduction of bank guarantee. So that's a bank's unconditional undertaking to pay one party in the event of another's default. So they are used across many industries to secure contracts, either in the trade of goods and services, or financial transactions, or industrial projects, the development of property, or the leasing of assets. The life cycle of the bank guarantee would be, in our scenario of the commercial property leasing, that would be a tenant that requests a guarantee from the bank, and the bank issue it. Then tenant would show it to the landlord. And if the tenant failed to pay the rent, the landlord could get paid from the bank. The issues in the current system would be basically all the bank guarantees are paper-based in Australia, and it's with significant cost with the paper management. And if we put guarantee as digital asset, it will simplify the life cycle management. And there's an issue of fraud. So the tenant could provide the same guarantee into multiple landlords. So the landlord, in the end, would be, they can't claim when the tenant can't pay the rent. It's inefficient reporting and management for the banks because storing, tracking, and reporting those paper-based huge system. And it is non-standard term and condition and formats. Variations in the articulation of contract terms and guarantee formats between banks, landlord, and tenants result in a large manual review effort. Blockchain can embed industry standards into the business rules of the platform to drive standardization. So I think I already covered why we use blockchain, because the bank guarantee are offered by multiple institutions, and many different applicants and beneficiaries require the use a single network managing all this, provide a single point to manage all guarantee a particular user is party to. And the strong security offered by blockchain and the nature of being a single source of truth greatly reduce the risk of fraud and the loss of documents. And bring guarantee providers into a single network can create a platform to drive standardization. In our initial proof of concept, we implemented 4 core capabilities in the life cycle of the bank guarantee. That's in the blue color. That's issue a guarantee, a mandate demand it and cancel the guarantee. And 2 other functions we implement to improve the usability, that is to search a particular guarantee and also report across multiple guarantees. The system architecture in a high level, that's all similar, use 3 tiers: the front-end application, the back-end, and use the Hyperledger Fabric to at the blockchain layer. So Fabric I will introduce a bit later in the next part. Now let's see the next use case in the insurance, in the car insurance. We call it AI-driven micro-insurance marketplace on blockchain. We first look at the global market opportunities. The customers, from the customer side, in the world, there are actually large number of drivers in developing countries. They drive without any insurance. The statistic about 65 to 70% in South Africa and 60% in India. And for the insurer's point of view, UBI, the usage-based auto insurance, is a kind of a trend that's expected to grow globally from 12 million to 142 million in 4 years. The value proposition for the micro insurance here, for the customer, it would reduce their premium by 5 to 30%, increase the transparency of the service of the insurance they are getting, making the purchase of policy easier, and reduce the complexity of their claim process. And for the insurers, it's a kind of innovative and new product and service. And also automate the underwriting and claims handling by use of smart contracts. It can improve the customer experience and reduce the privacy concerns on their personal and sensitive data. The outline for this project is to provide this dynamic pay-as-you-go insurance for the drivers. Basically, the driver gets insurance only for the trip they are going to take. It's instead of a monthly or yearly premium they are taking. This is because we see in the developing countries, people, it's kind of the affordability is a major issue for the auto insurance. And second is to provide a shared ecosystem for the insurance company to share the customer history. For example, the data sharing can enable the insurers to build more accurate risk model for customers. And they can also leverage the dynamic codes to adjust price based on the dynamic variables such as weather, time, demand for each trip. We envision there's the AI-driven insurance marketplace, which means lots of useful analytics can be derived from the data we are storing in the blockchain. For example, the driver's risk profile, their trips and claim history, etc. However, much of these analytics are not part of the core business of insurance companies. Therefore, there's a potential for this analytics to be offered via the marketplace. And the marketplace could include analytics such as the fraudulent claims identification, the route adherence to microinsurance policies. Motivation for using blockchain here is insurance companies have no basis for trusting each other, yet they also work together in the marketplace to ensure the allocation of policies for driver trips. The shared ledger is important because there is no obvious central authority that is not also the ecosystem participant. And the insurance companies will collaborate in sharing the driver and driving data, also compete in the marketplace. The last is the regulators. They can participate in the marketplace, and they can help their auditing and the traceability of policies and provide the regulatory oversight. The user interface is shown in this slide. This is the portal for the insurance company. Basically, we can see here the company, the insurance can check a claim details like the route of the driver, and also if it's comply to the policy to prove this claim. And for the driver portal, it's a simple user app, a mobile app that when they want to buy a policy to cover their next trip, they can input their start and end location and the time of their departure. Then the different insurance company would provide a code to the app, and the driver can select which one is the best suit for their purpose. The system architecture is showing in this slide. So we have the portal for the driver app for the insurance company, and then they interact with the backend support. Backend would support the codes aggregator, the trip data handler, including the GPS series, and also the service to process the claim and service to build the driver profile. And the blockchain implication here, we applied the Hyperledger fabric as well. The last use case here is the document and workflow management in trade and logistics. The value proposition here is more than 16 trillion in goods are shipped across international borders each year, and 80% of the goods consumers use daily are carried by the ocean shipping industry. By reducing the barriers within the international supply chain, the global trade could increase by nearly 15%, that boosting the economy and creating jobs. However, the pain points in nowadays global trade is highly inefficient and burdened by the paper-based process. That's data got into organizational silos. There's disparate perspectives on transaction state. And it is also a manual and time-consuming process, which the clearance process subject to fraud. By digitalizing the global supply chain would bring the benefit in connect the ecosystem, bring together all parties in the supply chain, including the traders, the freight forwarders, the transportation, ports, terminals, carriers, all the authorities into a blockchain-based platform with a secure permission and identity framework. It can drive true information sharing to provide seamless, secure sharing of real-time, actionable supply chain information across all parties to the trade, and can foster collaboration and trust in this global supply chain. I think I can skip this slide because the motivation to use blockchain is all similar for the shared ledger, for a single source of truth, use smart contract to automate, to provide privacy, and increase the trust among the participants. Now I can show a bit high-level workflow and payments in the current system simplified into 4 parties: the buyer, seller, the ocean vessel owner, and the discharge port agents. So current system, there are a huge amount of paper-based documents to flow between each other. And the payment is also usually delayed like 30 to 60 days until the goods get shipped. And if we implement using a blockchain system, it can improve the interaction and the workflow in the whole trade process. Like so here we abstract the interaction into six workflow event that is create the shipment, buyer to verify the documents and upload the mate certificate. The vessel owner would sign the document, and then payment notification in the last event would be transfer the ownership of the shipment. And for more information, you can go to the paper of last year's CIKM about this work. In part 2, I want to cover 2 platforms that is designed for the enterprise solutions. The first one would be Hyperledger Fabric, and the second one is the R3 Corda. Here I want to point out there are some misconcept about thinking Hyperledger is just one project like Fabric, but actually Hyperledger is an umbrella program that covers multiple blockchain projects. It is under the Linux Foundation license, and it's a collaboration created to advance the cross-industry blockchain technology for business. It was founded in 2016, and now there are more than 200 member organizations. It is open source, open standards, and open governance. IBM is a contributor to the Hyperledger Fabric, but it is not an IBM project. As I mentioned, it's under the Linux Foundation. The Fabric is an implementation of blockchain that is a foundation to develop blockchain applications. It has an emphasis on the ledger, smart contracts, consensus, confidentiality, resilience, and scalability. At the moment, the version 1.4 is released with a focus on the stability and production operations. The design goals for Fabric version 1 is to better reflect the business process by specifying who endorses the transactions, to support broader regulatory requirements for privacy and confidentiality, scale the number of participants and transaction throughputs, eliminate the non-deterministic transactions, support rich data queries of the ledger, and dynamically upgrade the network and chain code, support for multiple credential and cryptographic service for identity, and also support for bring your own identity. Overview for Fabric, there are a few key concepts here. Peers are the network service that maintain the ledger state and run smart contracts. Smart contracts constitutes the transaction logic whose output is agreed by the peer network. Next concept is channel, that is define the subset of the peer network to share the single ledger. That's to provide the privacy and confidentiality. Consensus is a process by which agreement is obtained on the peer network. Fabric also include a certificate authority that provides the identity service to participants on the network. The last concept is the ordering service that agrees the transaction sequence and distributes the blocks to the peers. The Fabric version 1's high-level architecture is shown in this figure. So we can see there can be external CA or the Fabric built-in CA to provide the membership service to give the identity service. And there's the ordering service to sequence the transactions and submit to the peer for the transaction to be endorsed and committed. The application interact with the ledger through the SDK that submit the request to the smart contract, and smart contract would get, put, or delete the word state and record the state to the blockchain. Note the delete here is not to delete the transaction in blockchain, but it can delete the key value pair in the word state. The Fabric ledger is maintained by each peer, and it includes two parts, like in the previous one. There's the word state and the blockchain. A separate ledger is maintained for each channel the peer join to give privacy and confidentiality, and the transaction has the read-write sets that written to the blockchain, and channel configuration are also written to the blockchain. The word state can be either LevelDB or CouchDB. LevelDB is a simple key value store, and CouchDB is a document store that allow complex queries. The smart contract decide what is written to the word state. Now I move to the second platform, R3 Corda. A bit overview of the Corda. It's a consortium of more than 80 of the world's biggest financial institutions, and the number keep changing at each time when I search. The consortium started in 2015 with 9 financial companies, but since then the key members, JPMC, Morgan Stanley, etc., decide to leave the consortium. The consortium seems to have taken a requirements-driven approach to design a DLT that is suited specifically for the financial service. And the Corda built based on these requirements and open source since 2016. The design principles for Corda is there is no blockchain and no broadcast, which means all the communication is point-to-point rather than broadcast to the whole network. It rejects the notion that data should be broadcast to all participants or to predefined groups. The data is shared on a need-to-know basis, and peers only see what they need to see. There's not sending is preferred by sending and encrypting. The message senders need to know the identity of the recipient. Corda applies the UTXO instead of the account model, so that's similar to Bitcoin and different to Ethereum and Fabric. The platform is JVM-based, written in Kotlin, and support industry standard protocols like AMQP, JDBC, etc. The fundamental concept in Corda is to mimic the legal agreements in the real world. In a legal agreement, there's those major components like the states, parties, their identities, the time window of effective, the external facts and conditions that govern the contract we usually call oracles. The witness we call notaries or observers, and the terms, conditions in the legal process, and the supporting documents in the attachment. The life cycle for agreement would be 4 steps: the creation, the amendment, novation, and renew, and then move to execute the agreement, and the last would be exit the agreement. So this mapping to the Corda network that I'm going to talk, like notaries, oracles, and the life cycle of legal agreements also mapping to the Corda transaction types. So a Corda network is composed of a daemon in the bottom. So the daemon is to enforce the rules regarding the information nodes must provide before they are admitted to the network. If satisfied, the node's identity is certified with the root authority signed TLS certificate. And in the network, there is 2 or more Corda nodes. That's JVM runtime with unique network identities running Corda with 2 interfaces in the network layer and the RPC interacting with the node's owner. There is the network map service. The map service will publish the IP address through which all the nodes can be reached along with certificates and the services provided by node. There is 1 or more notary service that's to attest the uniqueness and possibility, the validity of the ledger updates. And for the oracles, it can be 0 or more. That's to link the outside fact. That's to sign the transactions if they state a fact and the fact is considered to be trusted. In Corda, this UTXO state machine model is very similar to the Bitcoin. The difference here is it can represent any data type, not instead only the payment. The shared facts are represented by states using the UTXO state machine model. And the states are immutable and represent a shared fact at specific point in time. The state will evolve and allow new states to replace the old state, resulting in a state sequence. So once the new state comes, the old one will be marked as historic. The transactions in Corda, it's reference 0 or more input states and create 0 or more output states. The newly created output state will replace the input states, which are marked as historic. And there are 3 broad types of changes. can be facilitated by transaction to map the real-world legal agreement that's issuance, updates, and exist. So a bit step into the transaction first, issue the transaction, and then when you update the transaction, it input state reference would point to the previous one and mark it as historic. And when exit the transaction, the previous one will be historic marked. Okay, the last part of the tutorial would be a kind of summarize of the key lessons we learned. I want to cover the challenges that related to moving from proof of concept POC to production, and then talk about the governance and business models to accelerate the adoption. There are several barriers to making the blockchain solution to mainstream. First, I think is the unwillingness to share the organizational data, either because the misconception or it's the competitive nature of the business world to not share their data. And the second barrier would be the privacy and the regulatory compliance, like the GDPR put in able to forget, which in blockchain that's hard, that's difficult to permanently delete things. And the next barrier would be the challenges around the security and also the limited transaction speed compared to traditional database technologies. The path to enterprise adoption from different consulting firms or tech companies, they provide a similar roadmap, that is to think big but start small, that to prove the from a very small size discovery workshop to identify some potential use case and then design it, then you prove the value, and then you can grow it into bigger, involve in more participants, and to, in the end, build an ecosystem to enlarge the impact. So this diagram is provided by Deloitte. Basically for blockchain projects go through these different phases. And similarly, IBM provide these different phases, like identify the use case, build the business blueprint, and then move to the technology blueprint, then do the enterprise integration, and then it's the first blockchain project. Some key lessons we learned from building from POC to production, I can see that the governance is really important. Setting and maintaining good governance is really important for the steady progress. And early agreement on the REXI metric are critical for smooth transition to operation. So knowing exactly who is responsible, who is accountable, or needs to be consulted is very, very important in every step. And for the scope and method, it's jointly agree both the functional and non-functional MVP scope early as possible, and locking down what is considered being done in Agile is actually not obvious for the large programs when it's involve multiple participants. And estimating the wisely and calibrate the initial story points is difficult, and it's really important. And in the solution, don't underestimate the user onboarding along with identity and access management. So as mentioned, governance is very important. I go a little bit into the governance model for the three blocks in governance that include the business network governance, the blockchain network governance, and the IT governance. So the business part, it's the industry and use case specific, which need to factor various facts that evolution in the industry itself. It can include several things like the common shared services management, such as KYC, audits, reporting, the product and business network evolution, the enforcement of legal and regulatory frameworks. For the blockchain network governance, it is equally important. It's like the cost structure that is fairly spread based on participant activities, those including the membership, onboarding, offboarding, the data ownership structure for business entities joining and leaving the network, and also the network support service includes the business network SLA enforcement and the membership services. And the last building block, IT governance, it is focused on the IT infrastructure performance, cost structure, and the business risk. That includes the distributed IT management structure, model the distributed maintenance, the software and hardware updates, upgrades, and the path management. Also includes technology adoption and assessment that lead to keeping up with technology evolution and economic deployment models. For the business models, we observe basically 4 different types of business model. First is the founding member, founder lead network. That's a single company driving the initial project, then others join the network. If I refer back to the use cases, the last one, documentation in the trade and logistics, fall into this category. So that's a single company drive the whole network initially. And then second model is the joint venture network, that 2 or more create a joint venture to govern the initial network. The second use case in bank guarantee is such is an example. And another example is the Maersk IBM joint venture that's work on the global digital trade and logistics. The third business model is a consortium network. That consortium as the initial network and the governance in a specific industry or sector. The first use case in share KYC, all the banks, they join, they form the consortium network. And the last model is a business ecosystem. That's a consortium network working across multiple industries or sectors. So the macro insurance use case, like different insurance companies, the road authority, and regulators into this, join this ecosystem. To evaluate a blockchain project, we can follow a structure like put it into the benefit module and the cost module. So the benefit include 2 parts. Blockchain create new opportunity in the sense of membership and transaction income. The other part of benefit is to solve existing pain point, like to reduce the cost and saving, also increase the efficiency. And the cost part is can be evaluated from the pilot phase, the commercialization phase, and the ongoing cost. And the last part I want to talk is at Swinburne Blockchain Center, we focus on 3 parts: the research, development, and professional training. At the research part, we are working on the decentralized identity management and consumer data rights for open banking, the AML with Australian regulator, and research topic in the interoperability of the public and private blockchain networks. For development, we have a project called ArtChain. So it's a blockchain-based platform for artwork, registration, tracking, and authentication. We also provide short courses like one-day workshop for blockchain introduction. That's our partners from Capgemini, Cyro, Data61, ArtChain Global, and Australian government. The takeaway for my tutorial would be rethink on the notion of trust that enables exchange of value without trusting intermediaries, maintain a single source of truth, and share a set of business rules across separate entities without anyone being able to alter them and control the system. And in the end, it shifts the cost of trust. And blockchain is not a single solution for all problems. And also, it's more value added when combined with other technologies like AI and IoT. We look forward to exploring these opportunities with you. Thank you. We have a bit question time.
Yes. Any questions? Yes.
For the project which involves insurance companies and sharing data, what is the take on the privacy and the consumer protections for sharing the data which is personally identifiable? So with the project, with the identity, you said that the consent has to be given for sharing the information with other banks or other requesters. How that situation is for the other project?
I think the question involves the 2 applications. The first one is the insurance, the macro insurance, how to protect the driver's privacy, like their identity and their location information. And the second part is in the banks, the share KYC must know the customer. So for the macro insurance, it's the data collected from the driver is aggregated to hide their real-time location. Rather, it's the overall driving behavior, like the driving style, to give a risk score, like if you speeding or if you accelerate hard, to protect the real-time location. And for the second part, the share KYC, since the identity of the customer is must know in advance of the service provider, so that's not a privacy thing. That's a regulatory requirement for must know the customer. Does that answer the question? Thanks.
Hi, Isaac Sheff, Cornell. One of the most expensive things about maintaining a blockchain is ordering every transaction against every other transaction in one long chain. And it sounds like we don't really need a total ordering on each and every point for insurance applications or know your customer or supply chain tracking. So I'm wondering what work has been done in some of these application-focused projects in breaking that assumption so as to make things go faster and cheaper.
Yeah, this part we consider two parts. So first, it's not a total ordering across all the. let me start a step back. So these applications, we use Fabric to implement. And in Fabric, the key concept of channel, that's a subset of the other peers. So it's not a total ordering across all the blockchain, rather it's ordering within a channel that's already reduced the size of the problem. I forgot the second part. yeah, basically that's a channel. And so when we need the ordering, it's only we want to transact across the channels. That's the point. The ordering, the total ordering is required, and induce the overhead in the total sequencing.
Thanks.
Thank you so much for your useful tutorials. So I want to know, so can you share the progress of your projects, the projects that you introduced. So did you develop the system inside the research lab, or do you implement the system in the real social? Because I'm thinking how you, collect the data and convince the companies to choose your network. And if there's no network, so how do you get the database to verify the feasibility of your system?
Thanks for your question. So this application, they are at different phases now. For example, the bank guarantee. So that's the proof of work has been done through the research lab, and then it proved the value. So the participants of banks and the commercial property leasing company, they want to move it forward. So it then it become a joint work between the research lab and the global technology side. It's a collaboration to move this POC to the production. And for the microinsurance projects, it's a bit in the early phase, like in the idea and then research phase, get publish papers, talk to potential clients' insurance to basically to let the customers know the concept is there, the benefits is there, and would you want to consider to take part in the work.
Okay, yes, thank you very much.
No.
I'm sorry, so you said that you are researching about the proof of work. So can you let me know more detail? What kind of content inside the proof of work that you want to focus more?
Okay, so proof of work is usually a kind of small project that run in short time, basically like from 4 to 6 weeks to build this demonstration that to show the key capabilities of the concept that demonstrable to the customers. They are, because they may not be the understanding the technology very well, but when you show something that demonstrable, it's easier to attract their attention and then move to the next phase. So once the proof of work is done and once the participants want to move forward, then it's the pilot phase, like building more production level code, more realistic and more complicated and take longer time to work.
Yes. So what is the challenges? The most challenges in terms of technology that's of your projects?
What I see here is less challenge in the technology, but more challenge in the business and in the collaboration with customers.
Yes, thank you very much.
Thank you.
Ziyuan, Since we have a few more minutes, let me ask you a couple of questions.
Sure.
So Australia is known to be very active with blockchain activities. We have some OC members here that are trying to host this conference. I believe in 2 years it may be held in Sydney, Australia, this conference. But so financial services was the focus of your topic, using blockchain. How is
Yes.
financial services doing in Australia using blockchain? Can you elaborate some of the use cases and some of real examples that you know?
Okay, thanks for the question. So, as you mentioned, Australia is very enthusiastic in exploring blockchain, and the two industries I can see is financial service and supply chain industry. From other projects I involved in, so that shows we take this step by step. Like first, educate the clients, potential clients, and then we sit together to brainstorming. The research side would like to learn the real business problem in the industry, and the industry people provide their pain points. Then we think together how we can solve it with better technology.
Mm-hmm.
Yeah.
Okay. Question over there? Yes. Yeah. Can you use the microphone, please?
One further area in which there's a lot of activity in Australia is in the energy space.
Mhm.
So it's sort of peer-to-peer energy trading, so around sort of people's solar networks, for example.
And I'm assuming that you're from Australia as well?
Yes.
Okay.
Ron Vandermaiden from UNSW.
Great. Thank you.
I would like to know that whether the rollback is allowed when a severe fault in the blockchain, and how do you achieve this purpose?
Do you mean if we can change the?
No, not change, just fork the blockchain.
Okay, so I
Like-
think in
yeah.
the work I worked with, there's no fork. Rather, it's like new version based on the governance.
Yes.
So if the consortium or the participants agree on a change, then we'll submit a new version of the set of rules, like as coded in the smart contract. So instead of doing a fork, it's kind of upgrade to a new version of the rules.
Thank you.
Thank you.
Okay, if there are no more questions, thank you very much.
Thank you.
Ziyuan.